So, Jeff, let's bring in Iain Stealey, International CIO, Global Fixed Income, JPM Asset Management. Iain, great of you to join us today. We've just been talking about earnings here in the Squawk Box studio, and it certainly looks like over the past month that earnings on both sides of the Atlantic have been rather warmly received by investors who are also hoping for a somewhat less hawkish pivot from the Fed. But it sounds like you concur with Neil Kashkari of the Minneapolis Fed that the markets are getting ahead of themselves. Talk us through.
No, I think when we look at what's going on at the moment, you've got a Federal Reserve which is caught between the rock and the hard place in a way where we are starting to see some of the economic data show that we are seeing a slowdown in activity. But the reality is we still have exceptionally high inflation. The last print for CPI was 9.1%. It looks like we're going to get another very high print in the next couple of weeks or so. We saw the ECI numbers out last week, again, still elevated. So we're not yet at the level that we believe the Federal Reserve can categorically say that they've got inflation under control and can be looking to make this pivot to start to go the other way when it comes to monetary policy. So we still feel there's a lot of work for them to do.
When we talk about a lot of work, this is exactly how much work you're expecting. A minimum of 100 basis points of hiking still left to do. A lot of heavy lifting over the next 3 meetings of the year. Iain, in that scenario, what is the investment strategy for someone in fixed income?
I think it is becoming more of a challenging one because we've got the front end of the yield curve, which now to us looks underpriced. So I do think you want to still be short the very front end of bond markets. But when you look at what's happening further out the curve, the 10-year, the 30-year part, that actually you want to be focusing on what's happening further down the line and the slowdown in growth that is likely to occur when the Fed does raise interest rates. And also it's focusing on what's happening around the rest of the world. And obviously we're seeing a weakening again in places like the Eurozone. So for us, it's curve flatteners. That still makes sense to us. And then when it comes to spread product credit, I say, as you've just said, earnings, they're looking okay. We think corporates are in a pretty good spot at the moment, but we also need to be mindful that July was a very good market for returns when it came to corporate bonds, whether it be the investment grade or the high yield part of the curve. And we have come a long way over the last couple of weeks or so.
Iain, it seems like it is a time not to be too bold. What about just hanging out the short end of the curve here, just in case, we have a policy mistake? At least, ultimately, you get to participate with very limited risk.
So I think that to us, actually, the short end of the curve looks more challenged because it does feel like the market's now taking a step back and saying that, yes, we're going to get some more hikes from the Fed over the next few meetings. But amazingly, it looks like we're going to be cutting in the first half of next year. And if you go back and look through history, that isn't the case. You typically get more extended periods when the Federal Reserve is on hold at the peak of the cycle. Also, when you look at the economic data, let's say inflation where it is, unemployment where it is, it's not really an environment which says the Fed should be changing its stance when it comes to tightening policy. So for us, actually, the front end is more challenged. I think it's the longer end where that's somewhere that you could actually be beneficial if I'm wrong and growth does roll over and the Fed needs to react to that.
Iain, let's just switch focus for a moment here. We've obviously got a Bank of England meet this week, the market expecting a further rate hike, and we probably should talk a little bit about the risks around Italy. Maybe we'll go with the BTP Bund spread first. How alert to any widening do we need to be at this stage? How do you play this and make money?
I think you still do want to be underweight Italian bonds at the moment. I think we've got a challenging environment for the Eurozone. We've obviously got all the concerns that we have around gas and the slowdown that will have at the same time. Not too dissimilar to the Fed, the European Central Bank need to continue to tighten policy because inflation is not where they want it to be. I know they've put the TPI in place and it's going to try to protect European spreads, and I think obviously Italy's in a lot better place than it was over the last decade or so when it comes to concerns that we have around peripheral spreads. But for us, it still feels an environment where the trajectory is weaker Italian bonds relative to German bonds, and I do feel that is the way to play it for the second half of this year.
Yeah, and just on the Bank of England, what do you think the outlook is for the gilt market?
I think, again, it's going to be a similar situation to what we're seeing around the rest of the world. The Bank of England, we've almost got 50 basis points priced for Thursday. I don't see why they wouldn't do that. I'm sure we'll probably get some dissenters around that. But it's a case, in my mind, that the central banks need to be going quickly as soon as they can and try to combat inflation, because obviously the economic data is rolling over. And if they don't get their hikes in now, there may be more questions around whether they can do that going forward.